Brian Grimes, your real estate mentor, back with another action-packed session. Tonight, we're going to be talking about how many houses it takes to retire from the 9 to 5. So if you've been thinking about leveraging real estate as a way to get out of the hustle and bustle, make sure you stick around. I'm going to answer a lot of questions about how many houses it takes. So let's get into it. So the first thing you want to focus on is like your freedom talk. So you need to understand, in order to know how many properties you need, what your freedom number is. And that's different for everyone. That's like the pure wealth equation. And a lot of people don't know what the wealth equation is. Your wealth number is this: freedom, financial freedom equals passive income. When your passive income is greater than your expenses, when your passive income is greater than your expenses, you have financial freedom. That number is different for different people and at different stages in life. I've seen a lot of people come in with extremely high numbers, and a high number, like in terms of goal setting, if you set a goal that is so unobtainable or that you're not going to be happy at all until you achieve it, and it's so big and it's going to take you so long, or it looks insurmountable, you just won't get started. Also, when it comes to real estate investing, your true number is lower than you think, because a lot of people are thinking in terms of salary. Oh, I make 125,000. That's my salary. Well, what do you get paid after taxes? When they take those taxes out, how much do you have left every month? That's the real number that you're competing with when you're dealing with real estate investing. Because with real estate investing, the taxation, especially with buy and hold real estate, is extremely low to like no taxation because of the amount of depreciation and bonus depreciation that you can get out of these assets. So you really need about, I mean, depending on your state and how you're being taxed, if you're in California, New York, you need about half of what you think. If you think you need 125, you need like 62 in cash flow. And it's going to feel equal to working at 9 to 5 and getting whatever that higher number is. So have your freedom talk together. Once you have this mindset together, okay, I'm going in to cover my expenses. That number is lower than I think. I have to get really grassroots with it. You'll be able to set an obtainable goal that you can start to chip away at. And that's kind of step one. The next question we get is, all right, I got all that. I got my wealth number. I understand what's what. How many properties do I need? It's always the how many, because people want to know how many properties that they're going to have. And counting properties is fun when you're just getting started. What you want to think about is your average cash flow per property. This number can change depending on where you're at in the country. Of course, there are markets that cash flow more than others. So as you're chipping away at your number, you have to think about your product split, your average cash flow. I would say for me, in terms of targeting, I'm always targeting about, at least, I would say, net of all expenses, at least 400 to 500 a month. I know there are some people who will say 200 to 300 a month. So I'm looking for at least around 500 a month realistically, and then more. But 400 can make sense, in my opinion, because your cash flow grows over time. The properties will appreciate in value. They will give you tax losses, and then the rental income will increase with inflation. You can go with a conservative strategy, like I'm talking about. Section 8, buy and hold, single family, top 10 cash flow cities, affordable cities, and you can make a lot of money doing a strategy like that. I would say with a conservative strategy, you could do this. You could also do high yield strategies like, there are some commercial real estate strategies. There are some assisted living facility strategies that will pay, $10,000, $15,000 a month per property. So all you would have to do is go out and get one deal and set it up right. Even if that deal took you a year to establish, it instantly springboards you to $10,000, $15,000 a month. So you can do either strategy. Some people do a mixture of both. They come in, they try to execute on a flip where they hit a flip or two, and then they buy and hold, and they kind of mix it up between a conservative and a high yield strategy. But that will, depending on your strategy that you pick, that will tell you how many. Let's get into the math. The income that you need divided clearly by the average profit per deal, whether that's rental, whether that's flip, put in whatever your average is based upon your strategy. That's going to give you the equation of how many houses you have. But you need to factor in things on the buy and hold side. You need cash reserves. Not a lot of people talk about cash reserves. They're important. So some portion of your portfolio should be cash, and it's there to solve problems. Now, you don't want too much of your portfolio to be cash, because then it's not getting a return. It's losing to inflation. So you have to find that balance. But your cash reserves are about having a bit of balance, keeping some money on the side in case things go wrong. So scaling, that's the math. The math works out in a very interesting way. The last thing I'll say about the math is it's Exponential, not linear. The human brain is wired to think linearly. This happens, then that happens, then that happens, then that happens, and it's in a straight line. It's a straight line level of thinking. Whereas the math is actually exponential because of the scaling factor, because you could do three deals in the same amount of time it took you to do one. So now your timeline gets condensed because you're like, oh, it's going to take me 5 years to get 15 properties. It's going to take me 10 years to get 10 properties. But with scaling, it can scale 10 down into like 18 months with proper scale, or down into 2.5 years. Didn't even make it to 3.